Hello and welcome to the webinar on regulatory changes in the world of NBFCs. I am Riju, Chief Business Officer of ID5. I'm a keen observer of market trends and also one of the odd people that actually reads regulations line by line. So regulations are, as you know, rarely as simple as lines of text. There are full stories behind it. There are regulations impact user experience, adoption, technology, operations, governance, policies, risk, and fraud. There are so many different contexts or ways to look at regulation. It's actually quite an interesting topic. The NBFC segment, to which is most of our context today, has seen a slew of regulatory changes, such as the digital lending guidelines and the KYC master directions. And these have altered not only the pool of players, but also the rules of the game. And I feel it's a good time to reset things and maybe discuss what has changed, what the impacts are. And I thought I'd invite a few experts to this panel discussion today. So I have with me, the first panel already here. And the second panel will join about half an hour from now, about 20 minutes from now. So the first panel, it deals with some of the technology aspects of regulation. And it talks about how it is implemented by various NBFCs today. And it could get fairly technical also in terms of what the regulation means. So we've got two experts with me to help me understand this piece of text from the KYC perspective, as well as from the digital lending guidelines. With me is Megha Khetrapal. She's Director of International Fraud and Identity Solutions at TransUnion. She's a person who really understands risk and fraud and understands how tech may be used to solve that problem. I have also with me Ashwini Patil. Ashwini is SVP Product Strategy at Lendra. Lendra is, in fact, a pioneer when it comes to SaaS offerings in the space of lending. So really a lot of people observing the moves they make these days. So she will be looking at it from the perspective of how actual adoption happens also from a very technical lens. I have with me two other panelists who have joined a little bit early. Devang is I'll be introducing you later. Ajay, I'll be introducing you later also. So you may decide to stay or join later, but I will definitely introduce you guys in about 20 minutes time. So I think to tee things off, maybe it would make sense to actually invite somebody to give some context. So I've got Abhijit with us, and Abhijit can probably, Abhijit heads product strategy at ID5. He's just going to help us understand in very succinct terms exactly what regulations have been affected, and then we can begin our panel. Go ahead, Abhijit.
Thanks, Raju. Good evening, everyone. Let me just share my screen. Can I get the screen sharing access? Yeah. Yes. Can you see my screen?
Yes, I can see your screen. Go ahead, Abhijit.
Let me just quickly give an overview of the kind of changes that RBI recently brought about in the recent circular on 20th May and then a follow-up on 4th May, 28th April and the 4th May. So, and this is primarily related to the master guidelines, the master directions on the KYC, which deals with the customer onboarding, which happens for most account-based relationships, that is your savings account, your current accounts, and the loan-based relationships. There are quite a few major changes which has, of course, they have brought about in the recent regulations. The last time that they did this was in May 2021, which literally they were very prescriptive about the video KYC processes. Over here, they have brought about a few changes which I wanted to highlight so that the context is set for the next panel discussion. One of the key aspects of change which have been brought about is with respect to the scope of the full KYC accounts. So earlier, wherein either a branch visit or a face-to-face visit using a BC or using a video KYC was mandatory for opening a full KYC account, and only there was a minimal carve out for a min KYC account, so it is called, using the Aadhaar based EOTP process. That has now been changed to introduce modes like a CKYC or a DigiLocker in the entire non-face-to-face mode as well, which puts it on par with the Aadhaar based OTP journeys. Of course, that comes with a few caveats. While you can open a full KYC account using just a CKYC or other equivalents, RBI does recommend that these accounts have to be mandatorily tagged as high risk, and comes out with other caveats as well. Say, for example, positive address verification and so on and so forth. But I think that is a level of detail to find. That of course is one of the key changes that has come out in the recent regulations. The other one is they have become a bit more, actually a lot more prescriptive about the kind of AML screening which is needed. Earlier, where they had pointed out, there are two lists here and there. You screen it at the point of onboarding, that's fine. Now they have become extremely prescriptive. They have essentially mentioned that this is the entire list of, the anti-terrorist list that you need to screen. You need to update these lists on a daily basis. You also need to perform periodic screening on these particular customers, which again was not as explicitly called out earlier as well. Let me just put this down. Yeah. Then there are a few other changes which also have brought about, not with respect to just the individual based onboarding, but also say the entity based onboarding. One is GST verification. GST seems to be becoming more and more the PAN equivalent for businesses really. And the quoting of GST now seems to be mandatory in places where the GST is available, just like PAN has been made mandatory for individuals over the past few years. Similarly, I think there have also been certain PMLA guidelines which have come in terms of, say, beneficial ownership, ultimate beneficial ownership, the thresholds declaring it from 25% to 15%. Those have now been codified by RBI into the master directions, and they have basically said that 10% is the threshold beyond which somebody needs to be declared as a beneficial owner. So while there are also other small changes here and there which have been brought about, say, with respect to the ownership of data for VSAP and all those are more, incremental directional changes. These we felt were the key changes that have actually been brought about in the recent regulations. Now, while of course this is what it says, and while they have allowed these certain changes, they've also called out for a lot of caveats in terms of risk guidelines, due diligence, high risk accounts, and so on. Let's see how it actually translates to a potential flow for various types of entities. So this is keeping in context. Sorry. That was something. All right, sorry, I'll go ahead. Cool. So essentially, there are now different possible flows based on the assumption that CKYC or other digital equivalents have now been put on par with a full KYC based account opening. The first check that potentially could, if we were to imagine a digital onboarding flow in the new paradigm, this is how it could potentially look like for various entities as our supposition. Are the CKYC records available would be the first search that any FI would do in context. In case it is available, FI would pull the documents from CKYC. They would run certain document identification and validation checks to ensure there are good quality documents available in CKYC. By good quality, we mean they are legible. We are able to look at the photo, the data is up to date. It is possible to get that validated and so on. Because this is what we hear, and Riju will probably can second me on that, is that when we talk to various FIs, the quality of documents which is available in CKYC in terms of the clearness of the images, the ability for the FI to do further due diligence based on what we already have is always in question. So verifying whether good quality documents exist or not in the CKYC database when you're doing a pull becomes a very important check. Now, let's assume that this is not the case, that basically either the documents are not available in CKYC, it is possible for a lot of customers, or the good quality documents are not available. Then you would go to a normal flow where you would do a PAN and a proof of address verification, typically the Aadhaar verification that we call for, which is again possible using multiple modes like we have listed on the slide. Now, in either of these flows is essentially to establish just the POI or the POA part of it. What it still leaves us to do as an FI in terms of what RBI expects all of us to do is essentially three possible modes. One is where RBI is time and again recommending that video-based SIP needs to be the best mode of face-to-face account opening for digitally focused fintechs or NBFCs or banks. And that comes into number one, as that's the first possibility after all of these checks are done in order to perform additional fraud checks in terms of phase liveness, phase authentication, liveness, the locations check, VPN check, and so on and so forth. Video-based KYC offers us the best chance to combat fraud in that particular case. The second is where the fintech doesn't have the capability, or the NBFC doesn't have the capability to set up the operations at scale that we are talking about. A tablet-based journey where a banking correspondent or a business correspondent can actually travel to the home of the customer and perform a digital KYC process, which is the digital equivalent of the OSV process, which used to happen earlier, in which on the tab, the photo of the customer, the photo of the documents are collected, their watermark, geolocation is captured, and so on and so forth, which is essentially the video KYC taking place at the customer's location. That could be the second flow beyond the video KYC flow. And third option, which we do see certain fintechs certainly following, is because now due to section 40 of the new regulations, RBI has now blessed the CKYC pull as a full KYC. Just performing the phase match and the phase liveness, while that can of course entail higher risk, performing that for account of only these two checks and not any of the other checks for account opening process. However, this leads to a high risk account opening flow. The customer will have to be tagged as a high risk customer for sure. And what this also entails is, if you also look at the guidelines, is that for any high-risk customer, the AML and the KYC checks will need to be repeated at a significantly faster frequency compared to the low-risk customers. Low-risk customers, as RBI time and again reminds us, will need to be performed only using a face-to-face mode, which is either a video KYC or a branch visit or a digital KYC-based mode. So these are the three modes in which basically after all the initial checks can be done, that the onboarding can happen either in a face-to-face or a non-face-to-face mode. And after this, of course, there is a mandatory AML check. Here is where I would like to leave it to Riju to begin the next round of discussion. But the main question is, with these three kind of checks, where does this leave us with the question of fraud?
Thanks, Kavijit. We'll that's a lovely segue to the panel. I actually want to begin the discussion in the panel with an existential question. You might think that there are lots of applicants of loans who are being included into the financial pyramid, that to sign them up at huge volumes, it's a cost to do regulation, right? And anyway, you can detect fraud in other ways. There's no link really. There's no reason fundamentally to follow process guidelines stipulated. And indeed, there are some who do not take regulations that seriously as compared to, let's say, others who take it quite seriously. I'd actually like to ask Megha, why should lenders care about regulations at all?
You're asking the wrong person. So someone who comes with a lot of baggage on regulation and compliance. Yeah. So as per SICRA Act, all regulated entities it's mandatory for all regulated entities to do this due diligence on KYC, full bureau report before any lending. It's mandatory. It's not optional. Having said that, we've seen the world, we have seen multiple scenarios. I've seen personally, and many of us here have seen very closely, especially in case of cross-sell or new age. Sometimes, or wider new age fintechs, they end up not being overly cautious and have slightly higher risk appetite before lending or opening account. But I want to just indicate that significant amount of penalties is what RBI keeps on imposing. Even if we just check, then on RBI website, it's very clearly coming out that very recently on Karnataka State Bank, 23 lakhs penalty was given on non-compliance of KYC. Separately, like few weeks back, I also saw some additional penalties on multiple cooperative banks for flouting the norms. NBFCs, multiple NBFCs have also been penalized. We shouldn't wait for that to happen. For a question like this, that why should we care? There's a significant brand impact. customers' trust once gets muddled, it's very difficult to bring that back. And it's mandatory for us to follow these checks.
Thank you, Megha. I think I couldn't have made a stronger point than you in this case. So definitely it's about brand, it's about trust, it's about compliance policies, and you better follow the rules of the big brother who's watching you. And indeed, there's a lot of evidence also of these penalties. I want to move to Ashwini next. And Ashwini, you're somebody who has a lot of experience implementing it at very high scale with lots of lenders. So you've actually got experience across the board with so many lenders. I just wanted to understand more details of in this onboarding process, how you compare and contrast the different methods like CKYC or EKYC or video KYC, in terms of pros and cons, where you should apply it. What are some of your thoughts on this?
Yeah, thanks for that question, Riju, because it's something that we get very often, when to use what. So what we've seen is, especially with CKYC and, RBI pushing CKYC so hard now, but we all need to understand here, CKYC is what you give is what you get, right? Because the data to CKYC is contributed by the lenders only. So only if you will give a good quality data, you're going to get a better quality data from CKYC. So that is one very, very important norm that everybody has to, we have to look at both the sides here. We have to also look at contributing good quality data so that others benefit from it. And when others will do it, so it's more like a reciprocal ecosystem that's the CKYC is bringing to the table. Additionally, what we have seen is the data that we get from CKYC is not updated very often. Again, it depends on the market segment that we are looking at. So if I'm looking at a salaried person, residing in a metro city, I may still get a better quality data. But we have to look at all the tiers. And then that's the reason even when we design the KYC process in general, we've seen that it is across segments, we may have to do it differently. Again, with eKYC and Aadhaar coming in picture, before 2018, everybody was very happily using it. Even we could do end-to-end things with Aadhaar. And then again, when 2018, the norms changed. And now again, the norms have changed. So with eKYC, again, we are seeing again an increased adoption as such, but it differs in different types of journeys. Obviously, it helps because again, in the tier 1, tier 2 type of cities where the phone number is updated, where the biometric data is better captured. But again, when we go to rural areas, when we are going to tier 2, tier 3 cities, we are seeing that the data is not updated there, even with the UIDI against Aadhaar. Or we've seen that the biometric that was captured at the time of enrollment isn't correct or isn't matching the biometric of the person. So we've seen these failure rates to be higher in some areas. So every entity who plans to use these different tools that we have today, will have to look at taking a balanced approach. Okay, again, when we talk about journeys or digital way of doing things, there are different modes, right? So I have a self-serve mode, for example. If I'm doing this KYC in a self-serve mode, we'll have to look at so I'll just go one step behind here before I start with that. So what do we mean when we say that the KYC is done, right? So I'm looking at a proof of identity being established, a proof of address being established. So I know that this is the PAN card number, this is the address, they belong to Ashwini Patil. And then there's a proof of ownership that I am Ashwini Patil and this all belongs to me. And I'm also alive. So there's a liveness thing also, right? So in the self-serve journeys, all these matters because you don't have the customer in front of you. It's not a face-to-face journey. So we have to take care of all these things. In assisted mode, it is, you can also rely on your own officers to take care of a few things. So that's the reason, we can probably talk in detail on this later, where which mode we have to use in which type of journeys. I hope that answers the question, Riju.
It does, in fact. Thanks, Ashwini. This is actually a reason to think about it very carefully, because there are factors like segments and adoption, drop-offs, data quality, fraud, so many things that must be factored to decide which one to use. So thanks for that. Megha, moving on to you. I wanted to sort of shift direction a little bit in terms of what does regulation not cover. And so there are so many instances of fraud, for instance. Do you think there are new areas that regulation should cover that it doesn't today?
So if I'll say, if we shift gears outside of financial industry, then we see a lot of new age frauds cropping up. And it's only a matter of time when then they'll start coming to us, coming to our ecosystem, our financial ecosystem as well. So I have personally experienced instances where from these marketplaces like OLX of the world or 99 Acres, Magic Bricks, very, very genuine looking people and significant amount of fraud is being coming up. I'll share an example. In fact, I was talking about this example in the FinTech Festival last week as well. So we were trying to put a property on rent. It's a small flat in a residential area. And we listed it on this Magic Bricks and 99 Acres. And after a few days, we're getting a WhatsApp message from a person who's saying, I work in Indian Army. On the WhatsApp profile, again, the photo of India flag is there. And every conversation, he's saying Jai Hind, and this is what I want to do, and so and so forth, and a very nice English. And he's saying, then he's sharing his iCard, where again the iCard is proper Indian Army iCard. And then he's saying, this much amount I'll get from HRA, so my office will pay, and the incremental amount is what I will pay. So I am going to share your details with my office to transfer from my HRA. And then 8 in the evening, we're getting a call from the office, seemingly the so-called office of Indian Army accounts office. They are asking us for our account details so that they can transfer money. And I thought that, excuse me, this is government department. Which government department in India still, we're still in India, works at 8 p.m. in the night and is clearing accounts? How can they prioritize it like that? So then, the bell started ringing that this doesn't look all right, and then we cut the cords. And I called a friend who is in ministry and looks at the cyber crime unit, and he said, this Indian Army, pseudo-Indian Army people is extremely common.
It's happened to me as well, Megha. I didn't know your story. Exactly the same thing to me as well. But yeah, do carry on.
Yeah, and I was telling and you get so emotionally involved. Like my husband's trying to negotiate rent, and I'm telling him that, please, man, it's okay. He works in Indian Army. You should be giving him some discount, not overcharge. So that's how these are now the friendly kind of frauds, where there is some leakage in the system. They get onboarded, and we see significant amount of that catching up in P2P platform. Then we went back and checked the onboarding process on Magic Bricks, or the onboarding process as a tenant or as a seller on these marketplaces is fairly broken. And I see business opportunity also there, but regulatory opportunity as well. Though there is if you now go back and see that properly, there is a verified owner category, or there is a verified tenant stamp, but still the onboarding process is broken. They ought to follow somewhat similar process of what we do here in banking, to do liveness check, to look at the documents, whether the documents are fake or not, matching photo to the person, looking at geolocation based checks, device related checks. So I think that intelligence need to go there. Seemingly some regulation and recommendations are coming. OLX is where ministry is going to try testing the onboarding process. And if it will work well, then it will be replicated to other places. So that's one thing which I wanted to share from a personal standpoint. But even in the financial industry, I think there is significant amount of fraud which continues to be there. We believe that we have all these checks, but our defense is not fully layered. We ought to have our processes in a way that a high risk account, very similar to the RBI circular regulation which was being shown earlier, that wherever there is a high risk account, then additional due diligence must happen. We shouldn't be giving deviations on those accounts. We ought to ensure that a video KYC and a physical geolocation tag, whatever additional checks we can do, we must do. I think it's important to keep our guards up and have this layered fraud defense.
Lovely story, Megha. It's always a joy to have you on the panel with all the stories coming out. So I'll just try and sort of succinctly kind of summarize what you said. In my view, ease of processes, okay, doesn't mean adoption will increase, because through ease, you may have more fraud, and that just loses the trust in the ecosystem and people don't adopt it again. So I think it's a fine balance, really. One can't make it too easy for fraudsters to come in as well, is the feeling I get. So
yeah, 100%,
100%. Yeah. With that said, I actually want to move to another angle. So now, if you think about the KYC process, all these multiple factors coming in, now Ashwini, how does one build a resilient KYC process?
Yeah, so I think resiliency is the word of the day these days. So we were talking about resiliency at every step in the process being built. See, many a times when we are having these discussions across different entities, we've seen that everybody wants to do one way and ensure that everything is going to go that way. So DigiLocker, so everybody nowadays is like, we'll do DigiLocker onboarding, but DigiLocker onboarding, and then what? How many people in the room have actually, registered with DigiLocker or got their IDs downloaded to DigiLocker? And if that's the case in a metro city like Mumbai and Pune, then it's going to get worse, like I said earlier, segment wise. So when we are building resiliency in a KYC process, with CKYC coming, obviously CKYC is the first step that is preferred, because the data is, like we had mentioned earlier, it's the contributed data by the lenders. So it is a source of a verified data. So we can start with CKYC. In case now with CKYC, there are two things. One is the data recency, other is the data quality. Because we're going to get images also, and if the quality is not that good or the data is not recent, then we have to go to the step 2 of our KYC process, which is either we do it via DigiLocker or we do it via an OVD upload kind of a mechanism. Then in case, now again, we should also look from a customer's mindset, right? If I'm asking him to do only for KYC, I'm asking him to repeatedly try it in multiple manners, the customer experience then gets hampered. So building resiliency should not in any ways compromise on the user experience. So that's the reason what we have said is, whoever wants to start doing this now, adopt CKYC, they can try it out for 2 or 3 months, look at the ratio that they're getting. There is some portfolio analysis that they will have to see that, okay, my customer base, I have seen a better CKYC result in when it is coming from these particular geographies, when this is my customer segment. And then they design, so we can call it like hyper personalized KYC journey for customers. So it's not necessary that the KYC resilience and the process is built at a journey level or at an institution level, but we believe that it should be hyper personalized for the customer segment that we are looking at.
And I think that's the key to solving that problem. It's just that there is no one size fits all. You need to be able to adjust it and play according. It's like a jazz performance that's happening. People are just trying to play the music based on the mood. So with that analogy, I'm conscious of time, and I know there are a lot of questions that have come up. I'm going to make a strange request here, Abhijit, if you wouldn't mind answering some of the questions in the chat panel, because I think we're slightly overrun on panel 1. So I'm going to thank the guests here and move to panel 2. Thank you, Megha, for wonderful stories. Ashwini, thanks for the amazing detailed insights on the process.
Thank you so much.
So folks, stay back. Panel 2 is about to begin. And before we begin, I think there's a very interesting question we wanted to ask before we begin. So Rebecca, if you want to just flash that poll question, and I'll start introducing folks. All right, I'll let you read that and engage with that question. So now it falls to me to introduce other folks in this meeting, in this panel. And we start by introducing Ajay. Ajay is Chief Risk Officer at Cholamandalam, and a person who understands ground realities quite well. Speaking to him, I understood that he doesn't take the word digital very lightly. He takes it very seriously. So it's an honor to have you here, Ajay. Thanks for joining us. I've also got with me Devang. Devang is DGM at HDFC Limited, and I think of him as somebody who comfortably saddles the world of business and IT, so much so that people confuse him on either side. IT people think he's business, business people think he's IT, or is it the other way around? So it's great to have you, Devang, to this panel. Neeraj, I think you are one of those lone voices here. You're the CEO of CredRight, representing the entire fintech industry. So CredRight, folks, is a fintech based out of Hyderabad, looking at the segment of MSMEs and their lending. He represents their voice today, and we're going to direct all those tough questions to you. So thank you for joining us, Neeraj.
Sure, thank you.
Great. So I'm going to start off this panel discussion. I think I have a lot of fun questions for Ajay. So I'm going to begin with the first fun question. Hold on. So my question is, Ajay, are fintechs a threat?
Well, if you look at that way, today fintech companies, they use a lot of technology and innovative business models, and of course they are quite fast, very convenient. So in that way, they do win away customers away from the traditional NBFC, of which I'm also a part. So if you look at from that point of view, yes, you can say they are definitely a threat, no doubt. However, see, today NBFCs are partnering and can partner with fintech companies to incorporate new technology, digital platforms into their own operations and thereby improve their services. So if you look at the other way, the fintech companies actually are an opportunity for NBFCs also to enhance their offerings and customer experience. Similarly, fintech companies can also benefit from this partnership because today NBFCs have a very large book size. They have enormous experience in the market in all product segments, and definitely a huge brand value and scale up. So if you look at that point of view, it's definitely a win-win opportunity, which is very much available. If you go slightly more deeper into this, the speed at which the fintechs work in adopting advanced technologies is far ahead of the traditional NBFCs. However, in fact, NBFCs are also now adapting to new technologies, but yes, they do face some challenges like the infrastructure, frameworks, approval process, and which limit their, I'll say, if not ability, the agility for sure. And from that point of view, yes. But one thing we should also recognize that today, traditional NBFCs have an inherent advantage which fintech companies don't, which is the wide experience which NBFC has over the so many years in operations, and of course domain knowledge. So if you look at this point of view, probably NBFCs have an edge over the fintech companies. Today, a lot of fintech companies are there. Yes, they also face some challenges like changing technology. Their average is also lower. Survival rate, people retention is again a challenge for technology companies, in my view. So if I have to conclude, my view would be that rather than being a threat to each other, they're an opportunity for each other to work in partnership. So both traditional companies and fintech companies, if they look it as a win-win situation for each other, they work together. Ultimately, it will benefit the customer, and this blending will provide access, usage, and quality to the customer itself. So that's my take on it. Thanks.
Thank you, Ajay. I'm sorry about that very abrupt and bold question from my side, but you handled it so well. I think that is totally right. It's two different personalities more than anything else, because both of them probably have licenses. But if fintech is so technologically minded, they have a hammer for everything, right? Which is the technology hammer, and then they're also agile. On the other hand, there is a lot of risk sort of understanding of risk and prudence on the side of NBFCs, or at least the players who've been around for a while. So I find that they can definitely work together. I agree with you there. So let me now move to Devang. So I wanted to touch on the topic of home loans and deposits that you're quite familiar with. So I know that there's a segment that has its own quirks, right? So you can't just take technology and paste it into your area. I know I've felt it, I've been to the branches and I've seen it. So I would love to know what you see is the role of technology in your segment.
So basically, if you observe in terms of any tech or any in an organization like us, the idea is to cover either increase the bottom line, okay, or decrease the risk. So any technology has to service a customer in some way or the other, and at the same time service the business. That is the only way where the technology can be justified to an extent. Else it will falter. So even in case of CKYC that we guys touched upon, you just step back a little and see that what is it that the CERSAI organization is trying to achieve. It is trying to give an experience to the customer when he can walk into any branch, just give his CKYC number and his KYC process is done. That's the purpose. Whether it is implemented, to what extent it is implemented correctly, or whether on the entire journey of implementation where they are on a scale of 1 to 10, that's a different debate. But at least the intent is that. Similarly, I think Aadhaar has also done a great job in implementing the eKYC journeys which are there. If you saw, and as rightly, when it was almost initially it was free, if you recall the days, and then slowly they had to increase the entry barrier because kind of the data went into the wrong hands because of the implementation issues. So if you see any tech part is there to service business in terms of revenue, and second, service the customers in terms of value.
Definitely. I think that we often try to do it the other way around. So, which is we take the technology and we find where is it that we can apply it. So it's right, we have to solve the problem first. So great answer, Devam. I'm going to move to you, Neeraj. Neeraj, you and I have chatted about it, and I think that you spoke about auto fetch, and I love that part about it when you spoke. So I think it's almost become like a new mantra because at CreditRight you've done amazing things with auto fetch, and I was wondering if you could share your perspective on on how regulations and tech come together to make this auto fetch happen at your end.
Thanks, Raju. So, we had a different problem, given that we wanted to do lending to a segment which is remote, and we don't have as great a branch network as Mr. Ajay would. We were looking at the entire gamut as to how to get data and try and get this data without, or at least as minimal fraud as possible. Because, data tampering do happen. So we're looking at each component of what all data we require for underwriting and how do we get that. And that's where we figured out that in today's day and age, thankfully, you can auto fetch or get the data from the source itself in most of the cases. So for example, we all have now discussed CKYC. Obviously, it has made life easier. But even when you move towards financial documents, I guess account aggregator has been a huge innovation whose impact is yet to be seen in full force. Your ability with one OTP to fetch the entire account statement, and obviously, on the runtime do the analysis is a big boon. Plus, the benefit on account aggregator is with the customer consent, and I'm double underlining the consent word here. You can also have a periodic access to the customer's bank data, which can also, feed into your early warning signal. And because you are now directly fetching the data from the bank, there's no chance of fraud. Similarly, if I move to other parts of financial documents like GST or ITR, now both can be auto-fetched directly from the source itself. Right? So GSTN again is a wonderful, and by the way, GST data is also coming to account aggregator. Today itself, I think GST announced that from 1st of July, the data of GST also will be there in account aggregator. Irrespective, you can still fetch the GST data directly, again, after the consent of the customer and they putting in their credentials. And same thing for ITR. Now imagine the power, three most important financial documents, which is bank statement, GST, ITR, can now directly be sourced from the source without any tampering and on runtime. And the customer doesn't have to move an inch. And as a company, you are so confident that this data has not been touched with. Plus, there are other multiple documents, like, for example, in MSME lending, YIB or years in business become a very important facet, especially the business vintage. Earlier, all this you were accessing through shops and establishment. It is not easy for you to verify again whether those has been the real or tampered data there. But now majority of the states have opened their APIs, including the state of Telangana, Andhra, where you can check or verify whether those SND has been really renewed or not. So again, the years in business of vintage proof can be easily accessed and verified. So all this you can do at the click. We do it now in CredRite. Approximately 70 to 75% of all our applications or data are now sourced directly from the source. And believe me, it reduces the cost, it reduces the risk, it reduces the fraud, it reduces the tag, and it suddenly increases the customer awareness.
So, Neeraj, I think that's definitely an interesting point to make, because tech is not always the enemy or the friend. In the sense, it's actually something you adopt. It's a tool to make all of these things happen, like a drop-off or a fraud detection or fraud reduction, etc. This is something that you can enable. And it's great that the government is taking such huge steps to make it all available. So we've been shouting loudly for many years. So some of us are quite happy it's finally happened. So I'm going to stay with you because I had another interesting question to ask you. I was going to ask you the question was about, one might argue that there have been many changes to regulations, right? And one might even say there are too many changes to regulations, right? And some might even say that fintechs are a little bit bearing the brunt of it. So life cannot be completely as easy as it was maybe a year back, is my feeling. So maybe you can, explain a bit of these things like digital lending guidelines and the KYC, how it's sort of had an impact for in terms of context for others.
I think, Riju, we all see it coming, after the proliferation of payday loans and every other app coming in, which were using not the legal or extortionate way of collecting money back. There were even suicides in few cases, unfortunately. So, once the scrupulous element starts coming in, or just borrowing from what you were discussing earlier with Mega, I guess that, just because it is easy does not mean the adoption will increase, but rather it may erode trust. And I guess some of that do apply. And that's where RBI rightly so came up with many regulations. But I guess, the speed and the pace of regulations have stumped many. Now, just to focus on digital lending guideline, which has been a game-changing one for most of the fintechs, especially if you're not licensed. It had a huge impact. But I'll focus both on the positive and negative. I guess it is the first time when RBI also defined the concept of LSP or lending service providers. Till now, that word wasn't defined anywhere. It was always DSAs or people, who are trying to source application for you. But the service or the gamut of service provided by fintech had increased. And thankfully, RBI had defined LSPs now. So anybody who's providing end-to-end services or multiple services to an NBFC or a bank is now defined as an LSP. Anybody who has an app, and they're also, digital, where the customer has a digital interface, and now falls under digital lending apps. So DLA also has been defined. What RBI has also done is they've also very clearly stated out what all LSPs can store or get access to from the customer. I think that's a huge step because there was a huge challenge in terms of customer privacy. Given that the regulation is there, now we all know what information can be accessed and cannot be accessed and stored. So that helps. Collections, again, they have defined that the money has to go from customer to the lender directly. The LSPs cannot come in between. Obviously, there's a lot of teething problem for many fintechs. because many of the NBFCs themselves are not geared up to collect payments directly or reconcile them. Fintech was playing a role there, but now I guess a lot of work is being done on that area. And the one which obviously affected all of the fintechs is the FLDG. Though the jury is still out, but I guess by RBI, by saying that securitization norms have to be followed, I think clearly has said that at least non-REs and REs cannot have FLDG arrangements between them. So if the credit enhancement is out, a lot of NBFCs don't want to work with fintech, at least in a revenue sharing model. So that now, I guess, has to be sorted out, because in my personal view, the FLDGs were furthering the financial inclusion goal a lot. Taking the loans to remote places, to places where smaller loans are required, which may or may not necessarily be profitable for a larger NBFC or a bank. I think fintechs were able to do that. With FLDG gone or credit enhancement gone, that might be a question mark. Though obviously still NBFCs or fintechs can get licensed and then still continue to partner with NBFCs and banks in a different format. So that works out. So all in all, digital lending guidelines, other regulations which are coming in are bringing clarity. And given RBI is such a progressive regulator, I hope that the ethos of inclusion as well as innovation hopefully continues to move forward.
So I think the way people looked at it as a wild west, right, before, it's probably fostered because of a lot of gray areas. I think they start to make it more black and white. So I suppose the fallout is many things have to change in terms of how you adoption changes, technology changes, etc. I'm sure the fintech industry with entrepreneurs like you who are so agile and adept and know how to survive will figure out ways in this. So, and many fintechs have and are thriving again. So that's great. So thanks for that answer and for that context. I'm going to move back to Devang now. Devang, I wanted to ask you, if you think, so again, one of those fun questions I like to ask, you think regulations can be improved? So
you don't want me in another panel, it seems. So can I just touch upon a few of the pointers on the earlier question, if it's okay, by
yes.
step on someone. Basically, I think what you asked, that was very interesting. That see what happens typically in an organization like a banking or NBFCs or any organization which has a element of legacy associated with it, that those legacy kind of builds up to an extent where it affects the agility. I think now fintech understand our pain point. When a new regulation comes and you need to be agile to service various scenarios, in fact, your problem is multiplied because it is across organizations. So every organization will have a different take on it, and not every element will be black and white. So I think you will have little bit of flavor of what we are going through. So that is interesting. Now coming to what you asked, that whether regulations can be improved, definitely. I think improvement is a journey which everybody goes through, and that's
there is no easy answer like this. Yeah, you have to come up with proper recommendations. Can't just say that to get away with that.
See, it's in case if you look at any recent implementation, if you take about account aggregator, you take about KYC, you take about it. So I have given you the answer first. Maybe I'll explain it a little in detail. So, like for example, when KYC came up initially, there were no modification APIs which were implemented. Now those have been implemented. When we came with Aadhaar, it was very easy to implement. Some of those technical implementation took time in figuring out, because documentation was there, but figuring out documentation was slightly a difficult task, and it took some time where people implemented it. Even offline KYC, if you see, it's excellent. I think it's one of the. It's such a beautiful, as a developer or a coder, you tend to appreciate what they have done, and even in terms of account aggregation, to get everybody on the same page and help them. What lacks is the detail and the how it will play out in the ecosystem and ability to correct it. I think the feedback loop is something which needs more tightening overall in the regulatory system. If you take an example, secrecy, for example, the onus of due diligence is on the organization. Okay. Now, what does that translate to? That translates to, boss, you are in deep shit if you make a mistake of relying on somebody else's data. In that case, I'll have to take the data again. If I do that again, the whole ethos of having a low risk customer doing a re-KYC at the end of 10 years is lost. So, somewhere you could have, somebody needs to look at it with an eye of, as you rightly mentioned a while ago, that you need to have a balance of risk and customer convenience. So, which is what is happening here. So here you have put a regulation where I need to upload the data, but I cannot use it because one, the data is not up to the mark because of some organization, some corner not giving good data. I think Ashwini also touched upon that point. And at the same time, I am treating my customer like a super high risk customer, because the minute he goes into any organization, he has to again redo the KYC. So these are the kind of elements which need to be looked upon with the why behind this stuff. If that is kept in everybody's mind when they are doing those incremental steps of rules and regulation, I think it will be a much more cohesive environment for working. I think account aggregator is one good example of it, but here too, if you see, it will have to be tightly controlled the way Aadhaar was controlled to a certain extent. And everything evolves. If you remember, even Aadhaar, in the initial days, they were taking year of birth. And then they moved on to date of birth. So every element will move on. So I think definitely there is room for improvement. And I think overall the ecosystem is there. So we should be very proud that we are having a digital environment and having a strong regulatory environment which is pulling us in the right direction. Okay, now is the question of detailing it out and covering that feedback loop. I think then we should be great. Hope.
Great one, Devang. I think that firstly, RBI obviously has the best interest of the user at hand, and which is why the digital lending guidelines. So I don't doubt that any moment. I've seen, everywhere else the RBI is respected as a regulator. That's for sure, right? With that said, I feel that sometimes being in principle, writing all these policies, sort of hawa mein, to for lack of a better word, is not fair. There's some realities, deep reality, like you said. CKYC data, like you said, half of the time it's unusable because of the quality of it, and so difficult to trust it and to leverage it. So these ground realities really need fixes. And of course, RBI can't fix CKYC because of steps CERSAI and all. But somewhere, it has to come together. The realities of it must be manifested in the policies too. I think I see what the pulse of your answer is, for sure. Thanks, Devang. So I wanted to come to some of my nightmares and move to Ajay after that. So, and Ajay can probably solve my problem here. So I talk about the nightmares. And so you might have also seen these texts, actually. You see, please update your KYC text. Nobody here is a stranger to it. Right? I think you've seen so much social engineering happening where people say, give your KYC details. And then if you do end up doing it, I often wonder if my mom is doing it because she loves to click on links. If she's doing it and she's given her PAN card, right? And the next thing I think of is how simple processes have become. That if you provide the PAN number or a PAN card, it has the PAN number and the date of birth inside it. That if you just say, I accept, and that is consent, you can actually download the CKYC, search and download it, right? And if that is considered KYC, you're done. You've basically got Neeraj's PAN card and you become Neeraj on the back of that, right? So I find that nightmare, is quite possible, especially if we as part of the industry don't do something about it. And I feel like we should. So I think on that note, coming to you, Ajay, let's talk about the tough question of identity theft a little bit. What do you feel on this broad topic, one should do to sort of mitigate this nightmare that might happen?
See, from a financial perspective, if you talk, I belong to the era when as a branch credit manager, I used to go and give loans to customers. Go to a pawn shop, inquire about the references of the customer, go and visit the customer, and check his documentation and do an OSV, original seen and verified. And this tradition, habit, practice, whatever one may call it, we still carry it despite adopting a lot of digital lending. So your question, I can look at it two ways, from a lender's perspective and from a borrower's perspective. So if I look at it from a lender's perspective, because a lot of you know, synthetic identity frauds, they are all abound. So we have definitely in our organization blended the two. That is the traditional way of lending and the digital way of lending. So which we call internally phygital. So we cannot go away from both the models. That's what our experience has been. We are a fairly large organization with more than 1600 branches and with AUM, 125. It's okay. So yes, we have created a very robust verification mechanism for identity. As we were seeing, that army case, we all have gone through it probably, and daily calls come. DND is all over now. So yes, we do go to the source and do an identity verification. So like EA verification, OTP verification, API based document, all that we are doing to verify the documents which come to us from an identity perspective. Same thing is going for the documentation. Even we are trying to do agri document checks, property document checks when we give mortgages. You go to Delhi, you'll have 9 different zones and 9 different types of frauds. So here again, we blend both physical and digital. Data validation definitely is we are trying to do from so many external sources like credit bureaus, government databases, public records, and so on. I think a lot of fraud detection tools are available through AI and ML. So, we had many bureaus coming up with support to the lenders. We do a lot of training to our employees on how to identify fraud. So the red flags are there. And then we do a lot of suspicious account monitoring. Although we are not a bank, but still we do come across cases like uh, loans getting closed very quickly with a huge amount of cash. Okay, today there are far greater checks available which were not there earlier. But our basket of lending is very, very diverse today, from very small ticket loans to very large ticket exposures. So we have seen that this kind of checks are definitely more useful when it comes to the smaller ticket loans. When we do take larger exposures, then okay, this might support a credit underwriting mechanism, but we don't wholly rely upon it. So from that identity theft, we do make visits to the customer. Now even the new KYC policy, will make us categorize the customer as high risk in case of non-face-to-face if there is no VCAIP done or any other things taken for that matter. So from that perspective, definitely tools are there. So a lot of support is there, but we do intend to blend the two. As if you see the examples which are coming, as far as the customer awareness, if you come to the other side of it, a lot of education and awareness is still required. I have seen so many well-educated people falling prey to such kinds of phishing activities and so on. So that will only help, and I think we all banks and NBFCs can come together and create more awareness to our customers. So that's it. Today also while lending, we tell the customer, see, our guy will call you from the telecalling center, but please, we are not sending any links. Don't click on any link. Just you get a tele verification clause, please answer it. That's all. So that way we are also been trying to help the customer to create more awareness. So that's how I think we should look at it. So that's from my perspective in this topic. Yeah. Thanks.
Thank you, Ajay. That's amazing. I actually feel that as Megha was actually pointing this out, identity theft. In fact, there's a very, very simple way to look at identity. Leave all the KYC text aside. You have to think if the document presented is correct, and you could verify that against the government database if you want. You have to think if this belongs to the borrower or not. So you have to authenticate the person matches against this document. And you have to check his history to see if he's done fraud in the past. That's it. I think technically speaking, it's as simple in terms of basic principles. But we get confused often, oh, there's a CKYC, there is this, and we often forget basic principles. And then we get into all kinds of fraud. So, it's totally right. It's about often these good practices, it's about the hygiene that can keep us safe in the ecosystem. So with that, I do feel that we have run out of time. I wonder if there is time for some questions. Let me see if I can Folks, are you okay with another 5 minutes? The panelists here, we can probably pick one or two of the questions here.
Sure.
Abhijit, there's a specific one you want to pick because you probably scrolled through all of them. If you're still there, Abhijit or Rebecca.
Hey, yes, we are there.
Yeah.
We are answering the questions one by one.
Is there something you want to pose to the panel?
Just having a look.
I think there's an interesting one. I kind of know the answer to this. Can fintechs reuse KYC? Let's say, it's not uncommon to have more than one NBFC partner. Of course, I'll allow Neeraj to answer this. He kind of speaks to the FLDG guidelines a little bit, is what it's alluding to. So can fintechs reuse? So they may be working with more than one NBFC partner. How do you think one might reuse it? Is it possible? And then I'll pass it to the others as well.
Yeah. So in my view, the answer is no. You can't. It's because the lender is the ultimate lending authority, and they are supposed to be doing the KYC. So for each lender, the KYC is sacrosanct and has to be done individually with each borrower. So no, the answer is in my view, the answer is fintechs can't use KYC.
That's safe answer, right? Maybe the RBI is listening in. Right. And no, I think, I suppose there's the CKYC available, so it puts that spin as well. Just put it in CKYC, pick it up from there, in a way. Ajay ji, what are your thoughts? And Devang, what do you feel about sharing of KYC?
So, Ajay ji, would you want to comment or should I?
Please proceed.
Yeah.
So, basically, just breaking it into two parts, just taking a cue from what will focus on the basics. So there are two parts. There is one software and there's your data. Okay, the ownership of the data is always with, actually is with the customer. Customer is then giving a consent to the organization to use it. Okay, now it is with the organization or the RE, as per the regulation, who is the co-owner of the data along with the customer. The service provider or the software provider does not come into picture at all at this point in time. So he is not the owner of data. And that's why it's very, very important to choose your partner who is very trustworthy and so that the risk of misuse of the data is reduced. In addition to that, ensure to have appropriate ISG controls so that these softwares are audited, these elements are rechecked from to cover the risk which is posed by the partnership. That's the short answer and rather elaborate answer to Neeraj, one word.
That's a beautiful answer. Beautiful answer. Thanks, Eva. That's an amazing image you put in my mind. Software and data. Very nice. Thank you. And I think the time has come probably to wrap up because we've overshot and I can see people leaving as well. We're down to 70 from 110. So let me thank Ajay, Devang, and Neeraj for being part of the second panel. Let me also thank all the audience for joining and hopefully it was useful. Maybe Rebecca, Abhijit will look at the questions and compile them and send it out to folks as well. So thank you all. Hopefully it was quite useful to everybody. Have a good evening. Cheers.
Thank you, Riju, for having us.
Thank you.
Yes,
Thank you so
bye.
much, everyone. Thank you. Bye.
Thank you, team. Thank you.